Hello. Hello. Hello, everyone. Hello, good afternoon, everyone. Welcome to another installment of our ASERD seminar series. Okay, I'm Sir Peña Reyes, your host and moderator for this afternoon. So thank you for being here on site. We have guests on site and also um, guests via Zoom. Okay, so this will be an interesting talk. 50, 60 guests via Zoom. Okay, quite a good number. Okay? So, video and audio are okay. Thank you, Sir Jemmy, for uh, confirming that I'm audible. Okay, great. So let's just go through the usual house rules. Okay? We will let our speaker finish her presentation before we entertain questions. Zoom participants, please stay muted and stop sharing your video during the duration of the talk. So during our Q&A, we will have time for Q&A later. Please virtually raise your hand and wait to be acknowledged. Okay? You may unmute and show yourself when asking your question. We also have participants on YouTube. So those who are participating through YouTube, please post your questions in the comment section. Slides, videos, and other materials from the seminar are posted on our website only when the speaker gives her consent for sharing them. So, ma'am, no, we need to get your go signal po. Okay, so let me introduce our distinguished guest from the Bangko Sentral ng Pilipinas. Okay. It's great to have a chat with her while we were setting up for this. So, Dr. Veronica Bayangos. Okay? So, Dr. Bayangos has been the director slash principal researcher of the Bangko Sentral ng Pilipinas Research Academy since 2021. Okay? Previously, she was the director of the Supervisory Policy and Research Department and the Center for Monetary and Financial Policy of the BSP. She holds an MA and PhD in Development Economics from the Erasmus University in Rotterdam, the Netherlands. Dr. Bayangos has been a member of the Netherlands Research Council since 2008. Her published works cover the areas of empirical macro and international economics, monetary policy, prudential policy, macroeconometric modeling, and recently, climate change and nature loss risks. A very diverse range no, of research interests. Okay, so without further ado, ladies and gentlemen, friends and colleagues, I would like to turn over the floor to Dr. Bayamos.
Thank you very much, sir, for that very generous introduction. And thank you very much to the organizers. Maraming salamat. This is my first time here in Absurd, and I'm truly grateful. Now, before I present my paper, I'd like to inform first the audience that this is an updated paper from last year's paper. This was published in early 2023. What I did for this special presentation, and it's entitled, Does Bank Competition Affect Bank Risk-Taking Differently?, is to update the data set from March 2020 to December 2023. So it now covers the impact of the global COVID-19 pandemic. But this is only for the UKBs, that's the Universal and Commercial Banks, which I will explain later on, but I left the updating for trade banks and rural and cooperative banks. Now, my presentation will cover the motivation of the study in the next slide. What this paper does, I'll explain the measures of bank risk Then I will present the empirical methodology. I will discuss the results, and finally, I will conclude. The main motivation of this study is that an analysis of the different measures of bank competition and bank risk activities in the Philippines using bank-level data is yet to be conducted or to be computed. I felt that this motivation is insightful. Studies find that competition in the banking industry can improve productive and dynamic efficiencies through innovation, with the ultimate benefit being stronger economic growth. Now, these benefits compel central banks globally to provide a level playing field for banks by ensuring that policies are fair to both big and small banks. However, it's also the responsibility of central banks to ensure that individual banks and the banking system are stable given competition. Now, in this area, there is a current debate in the banking literature regarding the effect of competition on the stability of banks. For instance, in the traditional competition-fragility view, Jimenez et al. In 2013 explained that increased competition among banks could actually threaten the solvency of individual banks and endangers the stability of the banking system. This could potentially erode the franchise value of a bank, that is the ongoing concern or market value of a bank beyond its book value. This in turn could encourage a bank to pursue riskier policies to maintain, of course, its bottom line or its profits. Now, these riskier policies are expected to increase the probability of higher non-performing loan ratios and could lead to bank failures. By contrast, the literature also exposes the competition stability view, which argues that a less intensive competition could result in higher interest rates on loans, which may in turn raise the credit risk of borrowers due to moral hazard issues. Now, the increased probability of default could potentially lead to more problem loans and greater bank instability. However, such a situation allows a bank to protect its franchise value or market value by pursuing safer policies that contributes to the stability of individuals. The measures of this competition have remained limited in the case of the Philippines, as I said earlier on, because we don't have measures of bank competition in the Philippines. Now, in the next slide, what I've done is to have a first indication of the market concentration of the Philippines. I constructed a Herfindahl-Hirschman index, or popularly called HHI, which is computed as the sum of the square of the share of assets of each bank versus the total assets the total assets of the banking system. For we will call as UKB, Thrift Banking Group or TB, and Rural and Cooperative Banking Group or RCB, from the first quarter of 2010 to the fourth quarter of 2023. So it covers the global pandemic, the COVID-19 period. Now, if you will ask me what's the difference among these banking groups, well, the difference is their business model. The UKB, which in this paper includes 41 banks, catered to both retail and corporate clients. The thrift banks, which about 55 are included in the study, cater to specific sectors such as the real estate sector, retail sector, and mostly are subsidiaries of the UKBs. Now, the RCB group is composed of 457 banks and mostly located in areas outside the National Capital Region. And these banks cater mostly to agriculture and retail sectors, and some are subsidiaries of big UKBs. Now, what you can see in the graph is that in general, the Philippine banking groups are not highly concentrated. What I have done here is I used the Myers 2018 key ranges and market classification. What we can see here is that for range of 1,800, it's just a range. It means that the banking group is highly concentrated. But here, what we can see here is that the TB and RCB groups, which comprise around 7.2% of the banking sector's total assets, are moderately concentrated. The UKB industry, it occupies around 93% of the sector's asset, is less concentrated. You can see the decline in HHI of TBs and RCB from 2015 to 2017 due to larger banks being able to establish branches in markets previously only served by the UKBs. You can also see a gradual rise in HHI after 2008, which may be due to consolidation of some banks. Now, you will also see some blips on the HHI of thrift banks and RCBs in 2021 to 2022, so that's the height of the pandemic, as some TBs and RCBs had to recapitalize and increase their assets. For instance, in 2021, three big TBs had to merge with their parent banks. These banks include RCB Savings, PNB Savings, and HSBC Savings. Now, in the next slide, what I did was to compare the level of HHI, again, across banking groups with return on assets over the same period. Now, what you can see here is that the return on asset ratios has been generally increasing with the HHIs of UKB and RCB banking groups, although what you can also see, that's the below the zero line. What you can also see is that there are negative ROAs, especially during the COVID-19 pandemic, which is expected. What we can also see, what we can also deduce from this figure is that the generally increasing HHI of UKB and RCB could be due to higher degree of diversification among UKBs. In this paper, I also computed for the diversification measure using interest and non-interest activities among UKBs, TBs, and RCBs. What I found out is that the diversification initiatives of UKBs is higher compared to those of the thrift banks and the RCBs. Now, overall, what we can see from these two slides is that banks are generally stable, and that while recent big mergers and consolidation have increased market concentration, these are not enough to pose a threat to the overall competition, since market shares remain relatively well dispersed among the remaining players in the banking groups. The results also confirm that the UKB industry still has enough room for more mergers and consolidation without necessarily impinging efficient competition. Now, again, I mentioned earlier on that I included the COVID-19 period. Just to reiterate that I saw some negative impact of the pandemic across banking groups during the period June 20 to December 2022, but I've seen a resumption on the higher return on assets across banking groups. Now, what okay, in the next slide, I have identified some forces which I call forces of change in the Philippine banking sector during the past 2 decades. First, the BSP continues to leverage on the structural changes, including the financial sector reforms at it has started even before the global financial crisis to promote a sound, stable, and globally competitive financial system anchored on prudent risk management. Major components of these reforms include a set of reforms in the foreign exchange regulatory framework that started in 2007, the formal shift in the monetary operations of the BSP to an interest rate corridor system in June 2016, and the adoption of strategic financial sector reforms. Now, for instance, 13 waves of foreign exchange reforms have been introduced since 2007. And then in November 2014, which is a big reform, Republic Act number 10641 was approved, providing the legal basis for BSP to regulate and supervise the entry and operation of foreign banks in the country. In fact, as of end December 2023, there are 32 foreign banks that were authorized by the BSP to operate in the Philippines. Now, most of these foreign banks are branches and subsidiaries, and they originated from Asia-Pacific region. Now, in 2020, the BSP approved the digital banking license framework. Although in this paper, I didn't include the digital banks. In the next round of this paper, I will include the digital banks. A second, I should say, force of change is the BSP also pushed for a broad set of strategic reforms in the financial system to better promote financial stability. More capital-based measures and disclosure standards have been implemented since 2008, due in part to the implementation of the Basel III requirement. So this includes compliance to the 10% total capital adequacy ratio, the leverage ratio of 5%, which was introduced in July 2018. The BSP also introduced liquidity standards, which require banks to maintain highly liquid assets to ensure their ongoing ability to meet short-term obligations. What we have found out in the recent data is that the banking system continues to maintain sufficient buffers to meet liquidity and funding requirements as the liquidity standards have been complied with, or way above the BSP's regulatory threshold. Now, another force of change is the fintech, which developed rapidly in the Philippines, specifically during the pandemic period. In 2020, in fact, in 2020, there were about 200 fintech players in the Philippines, majority of which are in the business of payments and lending, while the rest are into e-wallets, remittance services, cryptocurrencies, e-commerce, insurance, and even regulatory technology services. Now, another force of change has been the increasing digitalization in payment services. In 2017, the BSP launched the Philippine Electronic Fund Transfer System and Operations Network, that's the PesoNet, a batch electronic fund transfer service which replaced the paper-based check system. The BSP also introduced some reforms in the digitalization in payment services. Finally, another force of change that I mentioned in this paper is the comprehensive regulatory relief measures, which were extended by the BSP to our supervised banks, which ultimately helped in managing the negative impact of COVID-19 pandemic. Now, just to mention a few regulatory reforms which were crucial in this paper, we have the staggered booking of allowance for credit losses. Banks could stagger the booking of allowance for credit losses as a result of the pandemic. We have the capital relief on provisioning requirements. Our supervised banks were allowed to add back increases in their provisioning requirements, which helped their capital buildup. Then, of course, you have the additional operational relief measures, like the extension of the single borrower's limit from 25 to 30%, and the relaxation in the minimum penalty for reserve deficiencies among banks. So this ultimately, this regulatory relief measures ultimately help banks to manage the impact of the COVID-19 pandemic. While deposits continued to grow during the pandemic, banks resumed its lending operations in 2021, although modest. The NPL, the non-performing loan ratios, went up to 4.3% of the height of the pandemic, but now it went down to 3% as of December 2023. Banks have maintained a coverage ratio of more than 100% during the pandemic, but now it's down to 100%. Allowance for credit losses to total loans have declined from the pandemic. The bottom line, in turn, the bottom line for all banks have increased by 15% as of December 2023. So basically, what these forces of change mean is that they help our supervised banks thread the competitive landscape of the Philippines, and at the same time, it helped them with the regulatory relief measures. It helped them dampen the impact of COVID-19 on their balance sheets. Now, I have two main research questions in this paper. First is that, does competition reduce bank risk-taking? And then another question is, does the relationship between changes in competition and bank risk differ across banks? In this paper, what I've done, as I mentioned earlier on, is to update the data set of the UKB banking group until December 2023. For thrift banks and RCBs, I still have to update that data set. I have constructed unique bank-level database all the way up to December 2023. I introduced new measures of bank competition using market power instead of market concentration, using assets. You can also do that using deposits, but that will be a topic of my next paper. I used detailed income statements, profits, and bank-specific characteristics of banks such as NPL, which I mentioned earlier on, liquidity, capital adequacy ratio, provisioning, and then deposit growth. I have included some monetary, financial market, and real sector indicators, changes in the physical banking networks. I introduced an index here of changes in the physical banking networks, which include the number of entry of banks, closure of banks, number of mergers, number of banks which had consolidation, and then I also included number of banks with new payment channels such as PesoNet and InstaPay. So I've constructed a separate index for that. Now, basically, I used De Ramon and Strogan 2020 paper. Here in this paper, bank competition is defined as industry-wide competition in terms of assets. And here, bank risk refers to solvency risk, or the risk of being unable to absorb losses with the available capital. Now, in the next slide, I argued that the findings of this paper basically fit into empirical research. The research on bank competition has been rising in recent years due to fintech, to innovation, but the findings remain inconclusive. Importantly, studies on how to measure bank competition using market power continue to evolve. This paper attempts to contribute to the studies that focus on analyzing the influence of bank competition, bank risk, and stability using a single country setting. As I mentioned earlier on, it explores the presence of competition fragility view and competition stability view using 542 banks across 3 banking groups. I endeavored to contribute to a better understanding of underlying regulatory drivers of competition in banking markets, specifically on how the regulatory structural and technological changes in banking markets affect competition. Finally, the paper provides an evidence on how to measure bank competition using market power even in the presence of greater uncertainty like the COVID-19 pandemic. In the next slide, I'm now going to discuss the measures of bank risk and bank competition which I used. I estimate the Z-score to represent the standalone bank risk for 542 banks. The Z-score is actually an accounting measure of risk calculated at the bank level using return on assets on the left-hand side. And on the right-hand side, I also included the total capital to asset ratio of bank, the standard deviation of return on asset of bank. I use a 4-quarter or 1-year rolling window of return on asset. Now, for the measures of bank competition, I use the HHI, which I mentioned earlier on. But here, I'd like to argue that the HHI is not actually a direct measure of bank competition, but it is also useful to compute this to provide comparison with previous studies. This ultimately will help assess the robustness of the results from a previous study. Now, I constructed 3 measures of market power to be more comprehensive. You have the H statistic, which captures the sensitivity of changes in interest rate revenues to changes in bank costs. A positive H statistic would mean that banks are more competitive. And then in the next slide, I also computed for the learner index, which captures the extent of price markup over marginal cost. And then I also computed for a Boone indicator, which measures the efficiency based on the elasticity of variable profits over variable costs, such that the Boone indicator is typically negative. A negative Boone indicator would mean higher level of competition among banks. Just to mention some points on the learner index. The learner index is here in this paper is calculated in 2 steps because the marginal cost is not directly observable. So just to share the technical runs that I did, I ran a panel regression with bank and time fixed effects of the logarithm of total cost on the logarithm of the total assets and banks input prices in constructing the learner index. Now here, the input prices are actually bank personnel compensation, so that's the salary of the bank personnel, the funding costs, and other operating costs. And then I added the estimated coefficients for each input price in this equation to the overall index, that is the learner index. Now, with regards to the Boone indicator, I actually did the same thing by first running a separate regression for the other components of the costs. But the bottom line is that the actual estimation is then compared to the 4-quarter rolling window of the return on assets. As mentioned in the previous section, the main assumption behind the Boone indicator is that more efficient banks achieve higher profits. But in practice, in this particular paper, the Boone indicator is negative, which means the more negative the Boone indicator is, the higher level of competition is in the market. So that those are the 4 measures of bank risk and bank competition, which I did first. Now, in the next slide, what I did here is to compare or to extend the analysis of the Z-score, which I computed against the different measures of competition and the implications on the overall bank stability. A positive, let's go to the Z-score, a positive and rising Z-score would mean lower probability of insolvency, which means lower bank risk, and therefore it suggests higher overall bank stability. For the H statistic, it's usually positive, which means bank risk declines, and this is consistent with competition stability view. Now, for the learner index, in this particular exercise, I find it negative, which means higher Z-score and lower risk. And this is consistent with competition stability view. The Boone indicator is the strongest measure of competition here. It's in line with the literature, it's negative. When compared with higher Z-score, it would mean lower risk, and it is consistent with competition stability view. So I have just summarized the different measures, what the different measures and bank risk actually say. Now, let's move on to the empirical methodology. The baseline model is equation 5. On the left-hand side is R, which represents a measure of risk of bank bid during a quarter. I forgot to mention that this is a quarterly estimation. I use the Z-score based on 4-quarter moving average of return on asset. Now, following De Ramon and Stroghan's 2020 paper, I interpret the Z-score as a measure of how many standard deviations a bank is away from exhausting its capital. As I mentioned earlier on, a higher value indicates lower probability of insolvency and therefore lower bank risk. Now, on the right-hand side, you have K, which refers to a measure of competition. V represents a vector of macro-financial indicators and other bank-specific characteristics. And then I analyzed the relationship between bank competition and bank level risk using separate regressions for each measure of bank competition for each banking group. So that means UKBs, TBs, and RCBs. Here, an issue that may come up is that the competition may be endogenous if weaker and less efficient institutions increase leverage and balance sheet size to avoid insolvency in periods of instability. So to address that, what I've done following Liu and Wilson in their 2013 paper, I use lags in the competition measures and bank-specific characteristics. Now, the choice of lag in this paper is supported by results of exogeneity tests that formally evaluate that the null hypothesis that the specified endogenous regressor, in this case, the competition, can be treated as exogenous. So that's the first part. Then, in the next slide, again, following De Ramon et al.'s paper, equations, I use a panel quantile regression for equation 5, where the left-hand side refers to the fees conditional quantile of bank risk given measures of bank competition, that's K, and then bank-specific characteristics and macro-financial controls, that's the V. Now, beta 1 and beta 2 are the vectors of parameters on competition and other bank-specific characteristics and macro-financial controls. The quantile regression produces multiple coefficient estimates for competition that are unique to each quantile of the conditional distribution of bank risk. Now, this approach allows the study to examine whether the relationship between competition and bank risk differs across banks in different banking groups. Now, of course, I had some robustness checks. I did some testing for equality of the coefficient estimates at various quantiles. I also checked for, using WOG test, I also checked for the normality of residuals, stability test. I also checked the overall standard error of regression. I did some alternative specifications for the model. As I mentioned earlier on, I constructed basically a dummy variable for the number of changes in physical network. And then I also included a dummy variable for COVID. That's from March 2020 to December 2022. As I mentioned earlier on, I included lag specification in bank competition measures, bank-specific characteristics to address endogeneity issue. Now, let's move on to the results. The first is the aggregate full sample results of the model. Looking at the full sample, what we can see here is that competition basically reduces bank risk-taking activities at the aggregate level, specifically for the UKB group. As I mentioned earlier on, these are actually the coefficients which I have taken from the estimations. It's a summary of the impact of measures of competition on bank risk. As I mentioned earlier on, the Boone Index appears to have the highest impact. And that's for UKB, for instance, it's 0.339, or the coefficient is 0.34. And it is consistent with the competition stability group. I have also, okay, for TBs, for TBs, what I have found out is that the H statistic is the highest among the competition measures, but it's contrary to what the literature actually says. Maybe because some TBs have merged even before the pandemic, so this has affected the computation of H stat. For RCB, what I have found out is that the learner index is the most, it has the highest impact compared to H statistic, even if the sign is positive, and it's even way higher than the Boone indicator.
Now, in the next slide, what I've done here is I use the Boone indicator for showing the results of the paper because, as I said earlier on, it's this indicator is the most consistent and the strongest. It creates the strongest impact on bank risk-taking activities. What we can see here is that competition affects individual banks' risk-taking differently. The Boone indicator and the Z-score are only significant to UKBs in the 40th to the 70th percentile. So there is only there is a group of UKBs where the relationship of competition and bank risk-taking activities are significant. All quantiles, but all quantiles for TBs and RCBs are significant, meaning the TBs and RCBs are competitive. And then what we can see here, what we can deduce here is that the impact of competition on bank risk depends ultimately on the underlying individual bank risk, especially for UKBs. Now, in the next slide, I use the results of regression, again using the Boone indicator because it's the most consistent. What we can see here is that the relationship between competition and bank risk is sensitive to other bank-specific characteristics related to the extent of diversification, the funding source or the funding source, specifically deposits, the capitalization, and surprisingly, it is also dependent on the real GDP growth. Now, what we can also see here, that's the CI, is that the rising cost-to-income ratio increases bank risk. We can also see the impact of changes in the physical banking network on bank risk as positive and significant for large banks. So there is still room for merger and consolidation. But it's negative for smaller banks like the RCBs. To summarize, what this paper ultimately finds is that bank competition affect bank risk-taking differently. That's actually the title, that's actually the answer to my title. Specifically, the paper reveals that competition reduces bank risk-taking activities at the industry level. The relationship between competition and bank risk is sensitive to other bank-specific characteristics such as cost efficiency, the extent of diversification strategy, funding source, capitalization, and growth of real GDP. The impact of changes in the physical banking network is also positive for UKBs, but negative for TBs and RCBs. This is an area for future research of this paper. I also find out that the negative impact of COVID-19 pandemic on bank risk-taking is only temporary. In fact, it's only focused on, you can also only see the impact in 3 quarters or less than 1 year. But for policies, these are useful findings. We can use it as inputs in the determination of systemically important banks, because the determination of systemically important banks are dependent on market power, on market concentration. Maybe we can also use Boone indicator or the market power. We can also see this, we can also use this findings as inputs in future extension of this paper, such as the combined effect of competition and innovation and financial stability. And finally, as an area of future research, I'm also looking at the role of non-banks. So that's pawn shops, e-money issuers, in driving competition, and finally, the impact of competition and on economic growth. So I'll stop here. Thank you very much. Sorry, it's so long.
Okay, thank you very much, Dr. Bayangos, for that very comprehensive, very thorough discussion. Okay. Maybe now we can open the floor to questions. So I think we have one from our Zoom audience, Andrew Pua, yes, has raised his hand. So Andrew, please,
Hi,
if you could.
hi, how are you? So thanks for the presentation. I have a small remark about the results 3-3, uh, and specifically the thrift bank coefficients. It's minus 0.031 with a standard error of 0.935, I think. How could it be statistically significant?
Andrew, sorry, I made a mistake of including an asterisk, but it's not actually. Yeah, I saw that earlier on, Andrew. Thank you.
Oh, okay, yeah. So it felt strange. So
Yes, that's right. That's right.
even the rural co-op bank thing, yeah.
Yes, 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 that's right. Thank you. Thank you for pointing that out. Yeah.
And I also wanted to know whether the database is sort of like publicly available or is it proprietary?
Uh, unfortunately, Andrew, many of the indicators that are used are not publicly available. Right. Right. Because I've used detailed accounts on interest earnings, non-interest revenues, which are not publicly available.
Thank you.
Thank you. Thank you, Andrew.
Okay. I think we have entries in the chat box. Are they inquiries? How about from our participants here on site? Dr. Wimmer. Why does competition reduce risk taking? I wanted to ask the same thing, yes.
Um, mm, well, maybe in terms of their products, right? In terms of the quality of their products, they are much more now much more with quality. In terms of let's say lending products would then if banks are much more competitive, right? Banks would tend to lower their interest rates, right, to be competitive with other banks, right? So that dampens your risk appetite, right? Right. So there are a lot of reasons that the bank would venture into to keep their clients and to keep their bottom line also afloat. So let's say for UKBs in the provinces, they would usually, for lending products, they would usually the interest rates would usually be at par, right, with other interest rates of their neighbor banks, right?
Just to follow up to that, Ma'am, do banks really just compete in price dimensions or in interest rates, or are there other ways that they compete for clients, no? Like maybe alluding to Dr. Wimmer's question, you really want to outdo your competitor that you would go so far as to uh, do business, no, with ninjas, no income, jobs and assets, no, uh, clients, no. So have we gone to that extent where actually banks, no, go for ninjas, no? I think that became a problem in the US when they extended all of these uh, very flexible mortgage terms to those borrowing houses, no, until of course the housing market collapsed there, no? But do we see that? Obviously, we don't see that here because it's more. What can you say about that, ma'am?
I mentioned that earlier on. Banks also compete not just on the price or the interest rates, but also the quality of their loan products, right? Like, for instance, real estate, uh, right? They would compete for faster loan processing, right? And services, right? Unfortunately, in this paper, I haven't highlighted that because I don't have data from the banking side. I can only see the interest, right? The interest component of competition. But I will certainly include that because that would indicate more information from the banks, right? And then they also do some increase or improvement in bank and client relationship, such as for big clients, let's say for loan products, they would instead go to their clients rather than the clients would go to the bank. So those non-price dimensions are also in play. Unfortunately, I wasn't able to highlight that in the paper. But I think that's even more interesting. Yeah, that's right. Thank you. Sir. Um, um, in the findings, I have an indicator that is significant is the capital adequacy ratio. So the capital adequacy ratio actually covers interest rate risk, market risk, that's under market risk. It also covers credit risk for any eventualities. That means the banks can use those buffer, right? And then you have the market risk. So those two buffers are well complied with by banks, as I mentioned earlier on. The bank's capital adequacy ratio at the moment is around 16%. the regulatory threshold set by the BSP is 10%, the BIS is around 8%. So that means for any eventualities, banks could use those buffer in their capital. Another indicator that is in one of my runs, in the final runs, it's not significant, but in the previous runs, it's significant, is the NPL coverage ratio. So for any eventualities, the banks are covered for additional eventualities in their non-performing loans. So, yes, in other words, banks in general are capable to absorb losses coming from any interest rate risk.
I've been informed we have 2 questions from our Zoom audience. So I'll read them aloud po. No? I think in the interest of time, we can only accommodate these last 2 questions. So Dr. Bayangos, no, I'll just read the first one, then you can answer, and then the second one. No? Okay. So from John Andre Pelayo, okay, I am interested on measuring bank risk or bank risk-taking activities. Okay, so are there any other alternative ways on how to measure bank risk other than the Z-score? Can Z-score be considered a reliable measure of bank risk? Thank you.
In some literature, they are using non-performing loan ratio or non-performing asset ratio. But in my earlier runs, I used those 2 measures, but I find that those 2 measures are not really that comprehensive enough to cover banks' risk-taking activities. But you can use that for basic measures.
Innovation. How is risk taking associated with innovation? And can you also do that? Can you study the effect of competition on innovation? How would you measure innovation? And just an additional one. I think it would be interesting if you actually try to examine the possible heterogeneous effect of competition on the behavior of banks. For example, differentiating between foreign and local banks, or banks of different, maybe how they are positioned currently in the market. Are they the leader banks or the laggard banks, something like that?
Yeah, that's, thank you, Jeff. That's very good questions. On innovation, actually, I tried it, but in the paper, the specification is lumped under an index called changes in the physical banking networks, right? So I included PesoNet and other forms of digitalization, but again, it's just a dummy. So it will be useful to find a more comprehensive measure for that. And then I agree with you that it is also interesting to look at the different subgroups within the banking groups, like the performance of foreign branches versus foreign subsidiaries, and even the big banks, say the top 10 versus the remaining domestic banks. So that would be interesting. Thank you.
Dr. Bayangos, one more from our colleague, no? Sir Jemmy, Mr. Genesis Kelly Lontok. Okay, hi, Dr. Bayangos. In case it was tracked, how do the numbers, like for example, our PH Bank HHI, compare with that of other ASEAN neighbors? May ano ho ba raw? Comparison, cross-country.
Yes, that would be another interesting extension. That's the easiest, actually among the measures, that's the easiest to compare across Asian countries, right? Because you will only use total assets, right? But that will be a good extension. Yeah.
Okay. All good things must come to an end. So it's already what, 5:06 p.m. Anyway, my apologies to those who posted questions, but we can no longer address them now. But perhaps if Dr. Bayangos would be willing to do so, we can compile those questions and maybe send her those questions through email, and we can they can be addressed through email after this. So anyway, let's put this session to a close. Thank you very much, everyone, for attending. Okay, so let me just go through the usual spiels. Okay, we have a website. Okay, so I would like to encourage everyone to visit our website for materials from previous seminars. So the link is posted here, ateneo.edu /ls/sos/economics. So a lot of wealth of knowledge here that you can tap. Okay, next slide shows our economic seminar series videos where you can find them. So we have them posted on YouTube and also on Facebook. So you can find them here. And I think for the certificates, participants who would like to request certificates, okay? So the request forms will be open for a limited time only. Okay? So emailing us directly to request for a certificate will not be entertained, meaning to say that you'll have to go through this process, no? Okay, for the sake of orderliness, no? And control. Okay, so certificates will only be given to those who attend via Zoom and who accomplish this request form. And for those who have successfully completed the request form, please wait for a scheduled release of the certificate. Okay, so may kaayusan na, no? Okay, so last but not the least, picture, very typical of Filipino culture. So I think we can end already. So that's it. Thank you very much. So Dr. Bayangos, thank you very much. That was an excellent presentation.